Imagine this. Legoland, the Hilton Hotel, and Ancestry.com are all owned by the same company, Blackstone. You know, the world's largest private equity firm. But what exactly does that mean? Private equity is one of the most powerful forces in finance. Yet, it's one of those things most people know little about. Let's dig into it. In the simplest terms, private equity is how big investors buy companies, improve them, and sell them for a profit. Let's break it down. Raise money. First, private equity firms raise capital from outside investors to create a special fund. Buy companies. Then they use that fund to buy companies, often using a lot of borrowed money. Make them better. Once they own the company, it's time to turn things around. Think leadership changes, cutting costs, improving marketing, or expanding operations. Sell for a profit. Finally, after about 5 to 10 years, the company is sold again, either through an IPO, making it public again, to another company, or to another private equity firm. Sounds straightforward, right? But let's explore where it all started and how it became a global financial powerhouse. The origins, from tycoons to today. Back in the early 1900s, big names like JP Morgan and the Rockefellers were already making big deals, buying companies and merging them into massive corporations. They were building empires, but they weren't flipping companies for profit like today's private equity firms. After World War II, the economy boomed, and new opportunities arose for investors. Enter George Doriot, a Harvard professor who created the American Research and Development Corporation, ARDC, in 1946. Doriot's big win was a $70,000 investment in a tiny company called Digital Equipment Corporation, DEC. When DEC went public in 1968, ARDC's investment was worth a whopping $355 million. This marked the beginning of modern private equity and venture capital. By the 1980s, private equity had shifted from betting on startups to taking on existing companies. But not every deal worked out. Some were massive successes, while others turned into infamous failures. Private equity today, major power players. Fast forward to today, and firms like Blackstone, KKR, and Apollo manage trillions of dollars across industries like real estate, tech, and infrastructure. But how do they make so much money? It's all about strategies and structure. One of the most common approaches is the leveraged buyout, an LBO. This is when a private equity firm buys a company using borrowed money, with the company's assets and future profits backing the debt. They don't always own the company outright. Sometimes they just own a large stake and use their influence to drive growth. Take Blackstone's acquisition of Hilton Hotels back in 2007, for example. They used an LBO to buy the company, made it more profitable by focusing on branding and franchising, and ultimately sold it for a $14 billion profit. But not all LBOs are this successful. Remember Toys R Us? Multiple private equity firms bought the toy giant in 2005 for $6.6 billion. Instead of reinvesting money into the company, the firms took massive fees, and in the end, Toys R Us went bankrupt. Sometimes private equity deals can fail spectacularly. Growth equity, a more sensible approach. Not all private equity is about taking on huge debt. Growth equity is more like the stable cousin of venture capital. These firms invest in already successful companies that just need a little extra cash to expand. The goal? Scale fast and dominate the market. Think TikTok, which was given a huge boost thanks to investments from General Atlantic and KKR. The high-risk, high-reward side, venture capital is where the real risks lie. Here, firms bet on small startups, hoping one will turn into the next Airbnb or Facebook. The potential returns are massive, but if the startup fails, they lose everything. But hey, even the most experienced firms make mistakes. Take Sequoia, for example. They lost millions on FTX and Theranos. It's all about playing the odds. Distressed investing, the dark side. Then there's distressed investing, where private equity firms buy struggling companies for cheap and try to turn them around. Sometimes they succeed, like when Up Capita turned around Game UK. But other times they strip assets/jobs and sell off everything they can. It's a risky game that can leave companies worse off than before. How do these firms get so rich? Private equity firms make a fortune by charging fees to investors, usually 2% of total assets and 20% of profits. They don't just sell companies to the highest bidder. They aim to sell at the most profitable time and structure deals to maximize returns. The companies they acquire typically pay off the debt, meaning the firm can walk away with a huge profit, often many times their initial investment. And that's how Blackstone, KKR, and Apollo became financial giants, owning everything from hotels to media companies to tech giants. They've built empires, and they're going to keep getting richer. But private equity is controversial. Sure, it's made billionaires out of investors, but there's also the downside of companies slashing jobs and taking on too much debt. So, is private equity the future? Would you want to be involved, or is it better to just watch from the sidelines? What do you think the future holds for private equity?